How come bonds aren't always issued at par? Hi, I'm Doug Carroll for Insider's Guide to Finance, and I'm here today to try to clear up a little bit of fixed income market arcana that many people often find at least a little bit confusing. Wouldn't it be simpler if all bonds were issued right at their par value, at 100? Well, that might seem to be a simplification, but for good reasons, quite a large range of securities issued in the market will come to market at a price different from par. Usually at a discount, but well, let's get into the reasons for why we don't always see bonds issued right at 100. Clearly, many types of securities would normally be issued at a discount to par. Securities such as zero coupon bonds or discount securities like T-bills or most commercial paper issues. Such securities pay holders only a single cash flow at maturity equal to the par value. So unless such securities were issued at a price below their par, at a discount to par, investors wouldn't be incented with a positive interest rate, a positive rate of return to maturity. But what about coupon bonds? It might seem like with coupon bonds that pay their holder a coupon rate above and beyond the principal amount, that such securities could always be issued at par. Well, it has to do with a coupon setting convention followed by many issuers. Now, not all issuers follow these conventions, but a significant portion of them do. For instance, in the U.S. Treasury market, or this is also a convention followed by many corporate and municipal issuers in the United States, as well as other issuers around the world, they will only set coupons at certain increments. For instance, the U.S. Treasury, they will only set coupon rates at increments at 1/8% of par. Say, for instance, market rates of interest were about 4%. Now, I'm going to use that phrase, market rates of interest, as shorthand for the yield to maturity the market is demanding on bonds of a given time to maturity and a given level of credit risk, like, say, 10-year BB rated bonds. Well, let's say the market rate of interest is around 4%. Well, if we look at the possible coupons for issuers following this sort of convention, the rate one increment above 4% would be 4 1/8, 4.125%. The next rate above that would be 4 1/4, 4.25%. Above that, 4 3/8, 4.375%. Or working down from 4, the next highest coupon rate would be 3 7/8, 3.875%. Just below that, 3.75%. Now, for an issuer following that coupon setting convention, unless the market rate of interest happened to fall exactly on one of those increments, the bond will not be able to be issued at its par value. Let's say the market rate of interest, the market yield to maturity, is 4.05%. Now, for issuers not following that coupon setting convention, they could set the coupon rate at 4.05, and that would allow the issue price to be par. But if it's one of those issuers that's following that coupon setting convention, that means that 4.05 falls in the middle ground between 4 and 4 1/8, 4.125. For issuers following that convention, what they will typically do is round the coupon down to the next lowest increment, 4% in this example. Now, it would be fine to set it up or down, but for more psychological reasons than anything else probably, investors would prefer to buy a bond issued at a discount than at a premium. So following that convention, if they adjust the coupon rate down to 4.00%, that means to be yielding 4.05, the bond would have to have an issue price of, say, 98.5. That's the reason most bonds, or at least a significant portion of coupon bonds, are issued at a price different from par. It's just that issuers are following some coupon setting convention. And it isn't necessarily at 1/8% increments. For instance, for a large portion of its history, the U.S. agency mortgage-backed securities market, Fannie Mae and Freddie Mac pass-through securities, they followed a convention where the coupon rates, really pass-through rates in that context, would be set at 50 basis point increments, 4%, 4.50, 5%, or working downward 4%, 3.5, 3%. And I don't mean to imply that that convention is universally true even in the agency pass-through market. But for a large portion of the securities, that's the convention they do follow. But that's the reason why we have so many bonds that get issued at a price different from their par value. It's because certain issuers follow a coupon setting convention, and when the market rate of interest falls on any rate other than right on one of those increments, to be able to offer the bond at a yield equal to the market rate of interest, they'll have to adjust the coupon rate up or down, above or below the market rate of interest, and that would result in an issue price different from par. I hope you enjoyed this video. You can go to our YouTube channel or Facebook page to see other videos on a range of investment-related topics. Or you can go to the website, insidersguidetofinance.com. At our website, in addition to the free video shorts, there are a series of modestly priced, in-depth training videos with running times of approximately 1 hour each that go into a number of subjects in greater detail. The website and Facebook page also contain information about open enrollment programs I will be presenting over the next few months, and my recently released book, The Insider's Guide to Fixed Income Securities and Markets.